All right, today we're talking about the mortgage market, which is something I just like to follow as a consumer personally. I'm bringing this up because based on historical relationships with other interest rates, the 30-year fixed rate mortgage is at an extremely unattractive level. And thus, if I were in the market for a mortgage right now, I'd seriously be considering an adjustable rate option with the anticipation that more attractive fixed rates are going to be available in the not so distant future. That's what we're talking about. Stick around. Now, I've done a few videos talking about this key relationship which exists between the 30-year mortgage rate and the 10-year U.S. government bond or the U.S. Treasury. But again, we're at an extreme level, so I thought this was a good time to kind of bring this back up to date. Now, if we start in the top, you can see the blue line. This represents the 30-year mortgage going back to the year 2000. And below that, again, is that 10-year U.S. government bond. And they're, as you can obviously see in the chart, they're extremely tightly correlated. And what we care about is the difference between the two, or the so-called spread. And we're graphing that in this bottom purple line. And as you can see, the average over the last 23 years or so is about 1.8%. So in other words, the 30-year mortgage tends to be about 1.8% over the rate on the 10-year U.S. government bond. Now, the reason we care about this spread is it gives us some basis to judge whether or not mortgage rates look attractive or unattractive. And as you can see down here, based on this last 23 years, right now, rates look very unattractive. In other words, the spread is extremely wide. In fact, we hit an all-time high with this spread, or at least the highest in this data set, just last year at 3.25 roughly. And frankly, outside of that, the spread is at the widest point dating back to 2000. The only other time we've seen spreads this wide are early in the pandemic in 2020 and during the global financial crisis period in, call it 2007, 2008. And frankly, this isn't really that surprising. You know, when the markets get nervous, lending conditions tend to tighten up, and it's tougher to borrow money, at least on good terms. And you know, we're right in the middle of another very uncertain time today. We just had a couple bank failures within the last month or so, and the Federal Reserve is still raising interest rates to try to bring inflation down. So the markets are nervous. But I bring this up because I think it's important for those that are in the market for a mortgage today. You know, if I needed to borrow some money to purchase a home, I would seriously be considering an adjustable rate mortgage, again, with the anticipation that there's probably a pretty high probability that we're going to see lower fixed rate mortgage offerings in the not so distant future. And again, that's just based on where spreads are today, and it's also based on the fact that historically speaking, when we hit a recession, mortgage rates tend to fall. And why is it? Well, it's because that's the Federal Reserve's one of their primary tools for helping the economy recover from a recession. It's bringing interest rates down. So with those things in mind, I would rather opt for something potentially like an adjustable rate mortgage, which is going to give me a lower interest rate today and give me that option to lock in a fixed rate mortgage maybe a year, 2, 3 years down the road. So that's just a quick update on the mortgage market. Of course, if you have any questions, make sure you drop those in the comment section. As always, just want to say thanks for watching, and I hope we'll see you on the next one.